All right, today we're digging into the Q2 2025 earnings for Stellar Bancorp. That's ticker STEL. Now, on the surface, this report looked pretty good, right? But the way the stock traded, well, that tells a much more complicated story. So let's get into it and figure out what's really going on here. So check this out. This is really the core of the story for the quarter. On one hand, you have this massive earnings beat. We're talking 51 cents per share, when Wall Street was only looking for 45 cents. That's a huge beat, over 13%. But then you flip over to the revenue side, and it's a slight miss. They brought in $104.2 million, just a hair under the $104.9 million everyone was expecting. A classic beat and miss. And that's the big puzzle, right? A 13% earnings beat, you'd think the stock would just take off, but it didn't. So the big question we've got to answer is, what did the market see? What was hiding in the details that made investors hit the brakes? And here is how it all played out on earnings day. The stock actually opened with some optimism, a little pop. But then it completely reversed course and finished the day down, almost 0.5%. Now, look, that's not a huge drop, but it's the direction that's so telling. It shows that investors weighed the big earnings beat against something else, and that something else won out. Okay, so to really get what's going on, we have to pop the hood and look at the engine room. Let's dig into the actual operational drivers for Q2. Okay, first up, the huge positive. And I mean huge. Loan originations just went through the roof. They nearly doubled what they did in Q1, hitting a level we haven't seen since 2022. I mean, this wasn't just a little bump. This was a massive acceleration in what they do best, lending money. And management was thrilled about this. The CEO, Paul Franklin, he put it perfectly on the call. He said, and I'm quoting here, "We believe it marks the return to organic growth." And for a bank, let me tell you, that phrase, organic growth, is pure music. It's the signal everyone wants to see. And it wasn't just loan growth. The rest of the report card looks pretty darn good too. You look at their key profitability numbers, like return on assets and return on equity, totally solid. Their book value per share, up almost 11% from last year, which is fantastic. And maybe most important of all, their asset quality was basically perfect. Net charge-offs were almost zero. So from this angle, everything looks great. Okay, so if loan growth was booming and the balance sheet was strong, what's the catch? Well, here it is. This is the little detail that I think spooked the market. Their net interest margin, or NIM, which is basically the profit they make on their loans, it got squeezed just a little bit. It dropped by 2 basis points. Now, that's not a disaster by any means, but it signals that their funding costs are creeping up. And in this environment, investors are watching that number like a hawk. And hey, just so we're all on the same page, when we say core NIM, we're just talking about the bank's pure, unadulterated profitability. It's the clean number, without any accounting stuff from past deals getting in the way. So that little dip, it's a real reflection that it's costing them just a tiny bit more to get the money they need to lend out. So there you have it. That's the picture for Q2. Really strong growth, but with this little cloud of margin pressure hanging over it. So what's the plan? Let's get into management's playbook and see what they're telling us about the future. All right, what's management's take on the road ahead? Well, they sounded pretty confident. First, they think that great loan and deposit growth is gonna keep rolling. Second, and this is key, they're basically saying that margin squeeze is over. They expect it to stabilize right where it is, around 3.95%. They also threw in a little something extra, a Houston tailwind from a federal spending bill that should help business. And finally, they're promising to keep a tight lid on expenses. A pretty solid game plan. And this discipline carries over into how they're planning to spend their money. They laid it out really clearly. Priority number 1, by a long shot, is to pour fuel on that organic growth fire. That's where the capital goes first. After that, they'll look at other smart moves. And way down the list, buying back their own stock, and they made it clear they'll only do that if the price is right. And they're not just saying this, they're actually doing it. Just last quarter, they went out and bought back almost 800,000 shares. They've got a $65 million buyback program authorized, and they're using it, paying about $26 a share. To me, that says they see their own stock as a bargain right now. They also made a few other smart moves behind the scenes, stuff that might not grab headlines but really strengthens the bank. They joined the Federal Reserve System, which is already bringing in extra dividend income. They got listed on the NYSE Texas exchange, great for their brand in their home state, and they're cleaning up their funding, swapping out expensive debt for cheaper options. All good, solid blocking and tackling. Okay, we've looked at the numbers, we've seen the good and the bad, we've heard management's game plan, so now it's time for the big finale,
the next call. We're going to put it all together and give you our take on what happens next for STL.
Let's just rewind the tape to earnings day one more time, because the story the chart tells is so important. The stock came in hot. Then, bam, that big earnings beat hits, and the stock pops at the open, up over 1.5%. Everyone's happy. But then, as traders and investors started reading the fine print, they saw that little bit of margin pressure, and the whole thing just fizzled out, ending the day in the red. But here's the thing. We think that one-day reaction was wrong. We're calling this an outperform. We believe the market got way too hung up on that tiny 2 basis point margin dip and completely missed the bigger, more important story. This company is growing again. So let's put some numbers to that. For the next quarter, Q3, we're looking for earnings to keep climbing, landing somewhere between 53 and 55 cents. We're also betting that management is right and that core NIM will hold steady, right around 3.96%. You put all that together, and it leads us to a 6 to 12-month price target of $35 a share. So, just to recap why we're so positive, it comes down to 4 things. 1, the growth is back, and we think it's for real. 2, that margin pressure is likely over. The bottom is in. 3, the market is totally sleeping on their smart share buyback program. And 4, they've got this unique Houston tailwind that other banks just don't have. It's a powerful combination. So that's our call on Stellar Bancorp. A lot to like here once you look past the initial noise. Of course, remember, this is all just for informational purposes. This is not financial advice.